In this video, we're going to talk about Forex trading for beginners. So it is very much going to be a beginner-friendly video, sort of like an introduction to the Forex market. Now, my name is Tyler Stokes from StokesTrades.com. I'm on a mission to become a full-time day trader, and in the first phase of this journey, I'm reviewing some stock market basics, and we are on Forex. So if you want to download my 6-month blueprint that outlines everything that I'm doing in the first 6 months of this journey, you can find a link to that below this video. So if you're a beginner, you're looking into getting into day trading, that resource can be very helpful for you. It's absolutely free. You can find it below this video. So let's jump right into Forex. So what we want to do in this introductory guide is we want to kind of just answer four main questions. What is Forex? How does Forex trading work? So very much a simple explanation, and we'll go over sort of one simple example, and then talk a little bit about leverage in this market, and then talk about why this market is so popular for beginners. Now, what I like to do sometimes is for definitions, I kind of like to use the tool Grok. It's the AI tool from X to sort of give us a definition of securities. They sort of do it in a more kind of fun and engaging way rather than some sort of dry material you might find on some other finance blog. So let's see what Grok says the Forex market is. So Forex, or FX, is short for the foreign exchange market. It's a global marketplace where currencies are traded. It's like a massive international game of Monopoly where the currencies are the properties and the players are trying to make the most profit. The market is open 24 hours a day, 5 days a week, and it is the largest financial market in the world with an estimated daily trading volume of more than $6.5 trillion. Now, Forex trading is like playing a game of poker with the world economy. You are trying to predict which currencies will go up in value and which will go down, and then you make your bets accordingly. It's a high stakes game, but the rewards can be great if you know what you are doing. But how do you know which way the currency winds will blow? Enter the fun and mysterious world of fundamental and technical analysis. Fundamental analysis is like being a detective digging into a country's economic and political news to uncover clues about its currency's future. Technical analysis, on the other hand, it's like being a fortune teller using charts and patterns to predict the future movements of currency pairs. Forex trading, it's an exciting and potentially lucrative way to make money, but it's also a risky game that requires skill and knowledge. So there you go. There's a sort of definition of Forex, and we're going to dive a little bit deeper into some of the components. So again, it's a worldwide financial market where individuals, we trade currencies. So you sort of trade the money of different countries. So how does that really work? Well, this market is decentralized. And when you hear that term, maybe you don't know exactly what it means. I sort of had a rough idea of what it meant, but I sort of needed to get a better definition. And this happens a lot in the finance world. There's a lot of like jargon and words like derivatives and arbitrage that sound really complicated, but you kind of just need to do a Google search or learn about the definition, and then it becomes much more clear. So decentralized, well, what that means is, if you imagine a big school playground where kids trade stickers with each other, there's no single place or specific teacher that's controlling where and when these trades happen. Instead, kids, trade stickers directly with each other all over the playground whenever they want during their break. There's no central authority making rules for how these trades should happen. So the Forex market, it's sort of like this playground. It's decentralized, which means there's no single location or central exchange where all the currency trades happen. Instead, currency trading is done electronically over the counter, which means all transactions occur via computer networks among traders all around the world rather than through one centralized exchange. So banks, financial institutions, governments, corporations, and then individual traders like you and I, we exchange currencies with each other directly no matter where we are in the world. And this sort of allows the Forex market to be open 24 hours a day, 5 days a week across all the different time zones. So just like, the kids trading stickers with each other whenever they want, traders in the Forex market, we can trade currencies at any time during the trading week from anywhere in the world. There's always someone to trade with, just like there's always some kid that wants to trade stickers in the playground. So that's what decentralized means. And that's one of the advantages for beginners to sort of get into this market potentially. It's because it can work really well with your schedule. If you're a beginner day trader, you might have a 9 to 5 job, you might have other commitments. This market may allow you to learn and start trading maybe in the evenings or when you have time with your schedule. So it's very popular for that reason. So let's get into like how the trading works. And the easy way to sort of ease ourselves into this is just to think about how people exchange money, particularly maybe when you go on a trip. So, if you imagine that you're planning a trip from the United States up to Canada, before you go, obviously you need to exchange some money. You need some Canadian dollars to use when you are traveling in Canada. So you might walk up to the exchange booth that's in the airport, or maybe you have a global currency exchange, company or business in your local town. And basically you go up and you might see on the board that $1 equals 1.3 Canadian dollars. So you're thinking, okay, my my United States dollars are going to go a long way in Canada, and you exchange $1,000 and you get $1,300 Canadian back. Well, without you knowing, you sort of just participated in the foreign exchange market. You sold US dollars, and at the same time you bought Canadian dollars. So that's sort of like a foreign exchange market transaction. You participated in the Forex market there. So, you've gone to Canada, you've had a good time, and now it's time to come back and you have some Canadian dollars that you want to exchange, back to US dollars because you can't use Canadian dollars in the United States. Well, when you go up to that board, when you return, you might notice that the numbers have changed a bit. So now, let's say $1, it just equals 1.2 Canadian dollars. So it's changed from $1 equals 1.3 Canadian dollars to $1 equals 1.2. So the purchasing power of the United States dollar in terms of the Canadian dollar has gone down. So this indicates, a weakening of the US dollar relative to the Canadian dollar. So $1, it doesn't equal 1.3 Canadian dollars anymore. Now it equals 1.2. So when you change back your Canadian dollars, you'll notice that you get a bit more US dollars back. When you went on your trip, one Canadian dollar would equal about 75 cents US. Now, when you exchange your money back, one Canadian dollar is going to get you maybe 80 cents US. So this change in money value, that is what traders in the Forex market make money from. When the currencies trade relative to each other, or when the exchange rates change relative to each other, this is where you can profit from in the Forex market. So how do you actually sort of trade these currencies? Well, in this market, the currencies are traded in pairs, and each currency pair represents the exchange rate between the two currencies. So in this sort of introductory video, I'm not going to go over all the currency pairs, but there are sort of 8 major countries, and then there are all the other countries that you can trade. And just know that when a currency pair has the US dollar in it, that is a very popular currency pair, and it's one that's traded the most. So a very popular one is going to be the euro and the USD. So the euro and the United States dollar. So when they are listed, you'll notice that they have 3 letters that represent each country, and they will be listed such as EUR/USD. That means euro and United States dollar. And the first country that's listed in the pair, that's called the base currency. And the second country is the quote currency. And, this standard convention in the Forex market where these currency pairs, they're sort of universally recognized. So there won't be a USD/EUR. The currency pair that involves the euro and the United States dollar, it's always going to be euro first and USD second. And if you wanted to see what the value was in terms of US dollars, you'd sort of just manually do the inversion. But the currency pairs are set up in a certain way that there's only one quote per currency pair. So EUR/USD, then there'd be, the pound, so the Great Britain pound/USD, but you wouldn't have the inversion of that. They are sort of just, there's just one sort of way that each currency pair is traded. But what you need to know is that the first country in the pair is the base, and the second one is the quote. And that's how you're going to read the exchange rate and understand the value between the two currencies. So for example, in the EUR/USD, Euro, EUR, it's the base currency because it's listed first, and the USD is the quote currency, it's listed second. So if the EUR/USD, if it were being quoted as trading at 1.2, what that means is that 1 euros equals 1.2 US dollars. So if you wanted to understand what US dollars was in euros, then you divide 1 divided by 1.2 to get the value of euros in terms of USD. But again, 1 euro equals 1.2 US dollars. That's how the currency is quoted. So when you buy and you sell and you're trading these currency pair, basically you're buying one currency while simultaneously selling the other. Just like we did when we went on our trip to Canada there, we sold our US money and we bought back the Canadian money. So if you were to buy the Euro USD, you're essentially buying euros and selling US dollars, and you're expecting the euro to increase in value relative to the US dollar. And then on the other side, if you were to sell this currency pair, then you're selling euros and you're buying US dollars. And again, you're expecting, in this case, the US dollar to increase in value. So, for me, it took a while to understand, when it's said that you're at the same time you're buying and selling. But just think of when you exchange your money for that trip, you're selling your US dollars and you're buying back the Canadian dollar. So that's how it works in the Forex market. There's always a currency pair that you're doing that with. So we've got a sort of easy example here. And what I thought I would do is just jump over to the whiteboard and I can sort of write this out and we can sort of get a clear understanding of the base and the quote for just this one simple example. So let's jump over to the whiteboard and I'll run through this example. Okay, so let's go over a really simple example of how this will work in terms of buying and selling and trading a currency pair. So we've got these 5 steps that we're going to go through in this very simple example. So the first step is we're going to basically choose a currency pair. And like I mentioned, there are many currency pairs to choose from when you kind of compare all the countries that you can trade in terms of their pairs. But there's sort of like 8 main countries. And then, anything traded with the USD is going to be a very popular currency pair. So one of the most popular ones is going to be the Euro and the USD. So right away, the Euro is the base because it comes first. So that's the base currency. And then the USD comes second, and that is the quote currency. And as we mentioned before, you wouldn't have the inverse. You wouldn't have USD/Euro. You would just sort of do that manually. This is how these two countries are listed in the Forex market. Euro is the base. USD is the quote for this particular pair. So then your next step is going to be, you're going to make a decision whether through, some sort of analysis that you've done, either, fundamental analysis. You might know something that's going on with these two economies. Maybe there's some politics involved, or maybe you're doing, day trading and you're looking at trends and charts. And, you need to make a decision. What do you think is going to happen with this currency pair? So let's pretend that you think that the euro is going to gain relative strength against the USD dollar. So what we're going to do is, for this one, is we're going to buy this currency pair. So we want to buy this currency pair. So if we were to pretend that right now this equals 1.2, again, the base is euro. So this means 1 euro equals 1.2 US dollars. So if we were to buy maybe 1,000 euros, we would basically want to buy 1,000 euros and we would need to sell $1,200 to get that, to sort of trade and get into that currency pair. So the next step, the market moves, and let's pretend it moves in our favor, and the exchange rate now goes to 1.21. So our analysis was right. The euro increased in relative strength to the USD. So now 1 euro equals 1.21 USD. So in terms of us, closing out this position, what we would do is we would want to now close it out. So we would sell our 1,000 euros. So now we would sell our euros. So that's 1,000. And we're going to buy back the USD, and we're going to, USD, and we're going to buy back that for 12.10. So we can see initially we sold 1,200 USD, and now after our trade went in our favor, we received 1,210 USD back, and we made $10 worth of profit. So that's a real simple way of how trading would work in the Forex market. And basically, this is what you are going to trade against, expecting one currency to go up relative to the other. And if you make that trade properly, you're going to be profitable. So that's sort of a very simple explanation of how this works. Okay, so the other thing that we want to talk about is leverage in the Forex market. Because if you were to kind of run through that example, you can see that, $1,000 in your account, when there's movements, you're not going to make a lot of money. And that's fine when you're a beginner, you're just starting out. You certainly don't want to risk a lot. You might want to even be trading with a paper account and virtual money until you have a system down. But the Forex market, the way that the currencies are traded is they're traded in lots, which represent $100,000. And we're not going to get into the technical aspects of all these trades. We just want to talk about leverage here and talk about how it's used in the Forex market. And again, just a sort of intro into this. But your broker is going to allow you to use leverage. So let's talk about how this works with a leverage ratio example of 1 to 100. And then we'll talk about it in terms of your capital being $1,000. So this is a leverage example that can be used, but you can also have leverage examples that are much lower. You can do a 50 to 1, you can do a 10 to 1, and then you can actually trade in micro accounts, so values that are much less as well. But let's just run through a leverage ratio of 1 to 100 for this example. So what this means is that for every $1 of your own money, you can control $100 in the Forex market. So your 1,000 initial capital, it can control $100,000 position in the Forex market if you are given leverage of 1 to 100 from your broker. So there's going to be, two scenarios for us to go through to see how this leverage works. Either one, you're profitable, or one, you're going to take a loss. So let's suppose your $1,000 can control a $100,000 position, and you're trading a currency pair and it moves in your favor by just 1%. So this movement on a $100,000 position equates to $1,000 gain. So without leverage, your 1% move in your favor with a $1,000 investment, you're going to make $10. But with the 1 to 100 leverage, the same 1% move, it's amplified your gain to $1,000, effectively doubling your money. But on the flip side, leverage, they say it's a double-edged sword. There is some risk and loss potential. If the market moves 1% against you, you would lose $1,000, which would wipe out your entire account. So without leverage, a 1% move against you, you would incur just a $10 loss. But if you have leverage, that same 1% move, it's going to wipe out your account. So some key points on leverage: it amplifies your profits, but it also does amplify your losses. So it can significantly increase your profits, but it can also wipe you out. So this was sort of an extreme example where, you get a 1% move against you. If you did that, your account would just go to zero. And basically what you can set up with your broker is you can set up terms where you can't go negative. So if you were to lose that $1,000, your account would just get wiped out. However, there are cases where, if you were not to close out your position and the market is continually going against you, so it dropped by 1%, maybe 2%, you'd be in a negative balance and you'd owe that money to your broker. But there are cases where you can set up sort of like a stop loss, so to speak, where if you go to zero, your account just shuts down. But if you had a bigger position, you might get what's called a margin call if you're using leverage. And what this means is that if your losses in your account, they're approaching your initial deposit, so your initial capital, your broker might call you and say, hey, you're about to lose all your money. Either, deposit more funds or sell your position and close it out. So that can happen when you are using leverage, and you probably want to set it up where, if you were to go all the way to zero, your account is just sort of shut down. But that's the power of leverage. You can use it to control a larger amount of money in the market, which is great when things go well for you. But, if the market turns on you, then you need to set it up where you're going to either get out of a trade and not let your whole account get wiped out. And again, this example was a little bit on the extreme side where you just have $1,000 and you're playing with 1 to 100 leverage, but you can certainly play with 1 to 10 leverage where, it's not as extreme moves in both directions. So that's leverage, and it's a big part of this market. So to wrap up this introduction, let's just talk briefly about why the Forex market might be good for you and why it's really popular for beginners. And I think the first main point is that 24-hour market. Personally, I'm on a journey to become a full-time day trader. And at the time of recording this, my schedule wouldn't really work well if I were to only trade on the stock market, which opens at 9:30 Eastern time to 4. I've got other commitments right now where I wouldn't be able to focus during the day. This is going to change for me personally. So I think I'm going to focus on stocks and options. But for you, if you're learning, you might want to trade at night. You might want to trade on around your schedule. And the Forex market, with that 24-hour market, is going to allow you to actually do that. Now, it's also very high in terms of liquidity. But basically, high liquidity just means there's a lot of action going on. There's a lot of buyers, there's a lot of sellers, and you can get in and out of your positions at the price that you want. Whereas if it was a low liquidity sort of environment and you bought at 100 and maybe you want to sell at 102, just for examples, well, there might not be buyers at 102 and you might not be able to get that price, and therefore you're not making a profit. And then when the fees kick in, you're not sort of being profitable with your trading. So high liquidity allows you to get in and out of trades, and it allows the cost of trading to be reduced, and it's the opportunity cost of what you can do with your money elsewhere. So high liquidity is very much involved with the Forex market. So that is great for beginners. And we just talked about leverage and low barrier to entry as well. So compared to some other markets, Forex trading requires relatively small amounts of capital to get started. So many brokers, they offer what I sort of mentioned there, a micro or a mini account. So it allows you to trade with minimal investments. Whereas, if you're buying some stocks that are, over $100, or, some stocks like Amazon in the past have been $1,000, if you were to sort of want to, buy and sell that, you'd need quite a bit of money in your account. So I think we'll stop it there. We talked, about what the Forex market was. It's the kind of the financial market where people are trading these currencies, and they're done through trading in pairs. You've got, your base currency, and you've got your quote, and you've got an exchange rate between the two, and you would buy or sell that pair based on what you think the price will be between the two currencies. So you could do fundamental analysis, look at what's going on in the economies based on political events and things of that nature. But then, day traders like us, we're going to do a lot of technical analysis and look at the charts as well. There's a leverage component of the Forex market, which is attractive, allows beginners to sort of get in at lower amounts. And then that whole 24-hour, 5 days a week, in terms of the market being open, it can be great for beginners as well. So I hope that you found this video useful. Very much an introduction to the Forex market. There's more to learn in terms of all the currency pairs and then how things are actually bought. And when the prices move in the exchange rates, there's some technical terms that are associated with price movements that are a little bit different than just buying a stock and seeing the dollar value. So we might get into that in future videos. So subscribe to this channel. I hope that you found this useful. And again, if you are someone who's starting a career as a day trader, you might want to download my 6-month blueprint that sort of goes over all the steps that I'm personally taking in the first 6 months of this journey. So thanks so much for watching, and I will see you in the next video.